Hi, I'm AP, FSU MBA, and I want to make you some money today. Altria Group, ticker symbol MO on the New York Stock Exchange, is not a company that I will be investing in right now. I'm not saying that Altria is a poor company. I just don't see where the growth comes from. This is a company that will be one step forward, two steps back for the foreseeable future, which will be outlined in this video. Altria Group, through its subsidiaries, manufactures and sells smokable and oral tobacco products in the U.S., offers cigarettes, mainly under the Marlboro brand, as you remember Kramer, the old videos from Seinfeld, large cigars, pipe tobacco, smokeless tobacco products, probably more familiar with the Skoal, especially if you play junior hockey, oral nicotine patches on the On brand, e-vapor products under the Enjoy Ace brand, and so on. There are a lot of upsides to this company. It's been around since 1822 and never stopped increasing its dividend every October the past 10 plus years despite the COVID pandemic. It's a cash flow king and has $3+ billion in its bank account as of its most recent quarterly earnings. Its margins are tremendous. Just think that for every dollar Altria makes, it's putting around 45 cents of that dollar in its pocket. Nicotine and tobacco are addictive substances, so their share of customer and really their lifespan of customer has a pretty long runway. The company trades an earnings multiple in the single digits, so right now you're not overpaying for it. But ask yourself, what are you buying Altria for? If you're buying this company for dividend growth, I get it. It's hard to argue with Altria's track record in that regard. But how much longer can Altria play this game? Its dividend yield sits at around 9.5%, payout ratio over 80%, which in my opinion is alarmingly high. Its top line revenue has hovered around $20 billion since 2020, which is impressive, but 2023 was actually Altria's lowest revenue total the past 4 years. At what point does Altria start tackling its long-term debt? As of December 2023, Altria has a bloated $25 billion in long-term debt on its balance sheet and another $7 billion of current liabilities on top of that. If you're buying this company for share price appreciation, I just don't see how it grows without becoming a company like Kraft Heinz, which was a serial acquirer of complementary businesses to add to its portfolio. This is their strategy. It acquired Enjoy Holdings for $2.7 billion last summer, but had to do it with a combination of available cash, a term loan, and commercial paper, which is a fancy term for short-term debt instrument, kind of like a bond. Essentially, just adding to its debt pile. Altria says that investors won't see the fruits of its acquisition on its financial statements until 2025 and beyond, but its trail of overpaying to grow is visible on its balance sheet. This company has $6 billion in goodwill as of December 2023, which inflates its assets because it's just an indication of an overpayment on our acquisitions. When you pull up Altria.com, the company's slogan is moving beyond smoking, which is splashed everywhere. From tobacco company to tobacco harm reduction company is what they go with. I don't know who approved that. Tobacco pouches, which Altria considers a less harmful alternative, which still gives you mouth cancer, had to be acquired for $250 million. In 2019, it purchased a stake about 45% in Kronos Group, which is a highly unprofitable cannabis company, which I can guarantee has declined in value since 2019 because investors realize that they don't make money. The verticals that Altria wants to get into are not as profitable as their core business, which is traditional cigarettes, and it's going to cost them a lot of money to grow. Unfortunately for Altria, it is married to this dividend streak that it's on, and I think it hampers its ability to pay for these acquisitions in cash, or more so in cash. Altria bought back $1 billion in stock last year too. How much longer can it continue to burn the candle at both ends before it's stretched too thin? The company reminds me of a sports franchise that overpays for players, pushes the salary cap to the limit doing so, but in reality, it's just a company that struggles to grow and develop its younger players or its prospects. In this example, companies currently within Altria's control. So what do you do if you're already invested in Altria? Well, it just depends on numerous factors. One is your entry point. The company has traded relatively flat the past 6 months, no higher than $45 a share and no lower than $39, and right now it's trading in the middle of those two outcomes. If you took a position in the high 40s, I would hold and collect the dividends. The dividend is not at risk of being terminated in any way. And even if Altria suspended its dividend hikes or even cut its dividend and knocked down its debt, it would still be intriguing income play. But if I was in at 38, 39, I'd sell and find an income play with a safer payout ratio and more organic growth prospects. Got a company you want reviewed? Feel free to drop a comment below and we will entertain it. We want you to make some money on this channel, but in return, please like and subscribe, and I'm gone.